think that this is a good pausing point to talk about our 5 good minutes topic, which this month is reinvestment risk. Sorry. Reinvestment risk. Tom, think we can do 5 minutes on reinvestment risk?
Yeah, yeah, kick it
All
off.
right, so let's define it, which is something you were just getting into, which is rates are high right now, and a lot of people are hiding out in government money market accounts. Why does that matter? Well, each month, sometimes more often, sometimes less often, they're going to change the rate that they pay you out. So if the Federal Reserve were to cut rates or prevailing interest rates, especially on the long end, were to fall a lot, you're suddenly going to go from getting 5% on an annualized rate to maybe 4 or 3.5. Every time we have a Fed meeting or a Fed release, or recently it's been more the inflation releases, 20, 30%, sorry, basis point moves happen across the entire Treasury curve. So if that's happening at the Treasury curve, all of these other products are going to get priced accordingly. So you may wake up on a Tuesday, rates are at 5, and on Wednesday they're at 4.8. So you have now lost the chance to go invest at those higher levels. Let me give you a real life example. So this summer, the UK market, it's called gilts. It's the equivalent of their kind of their short-term notes for our U.S. Treasuries. Their 2 year yield at 5.5%. That was back around July or August. It's now down to 4.5%. So if you were investing back then, you could invest at 5.5% for 2 years, which is pretty good. You're guaranteed that. A few months later, when you go to do it, you're only getting 4.5. Now, if you have $1 million, that ends up being a lot of money. If it's, let's say, $100,000 to make it more reasonable, you're going to lose out on a tremendous amount of interest just by waiting around. And this is important because everybody's sitting in government money markets. It's a great deal today, but a year from now, prevailing interest rates are at 2 or 3. You could have locked in a U.S. Treasury, a UK gilt, something else that's also safe for 4 years, 5 years, 7 years, 10 years, and guarantee yourself 4, 5, 6% for the next decade, as opposed to sitting in cash equivalent of the money market for 5%, and you might not have that months from now or a year from now.
Yeah, I think it'd be fair to say, just to sum it up, that a money market is a 30-day rate. It typically changes every 30 days, up or down, or stays flat, depending on where the Fed funds rate is. And to your point, a year from now, the Treasury market or the bond market is pricing in almost a 1% cut from where we're at today, is from the last numbers I looked at, which you'd be at, if you're at 5.25 in a money market, 5.3, you're at now 4.3. So to your point, now the give and take is you have full liquidity, full flexibility. You're not locked in. You can go in and out of that. Whereas you buy a 2 year bond or a 3 year bond or a 10 year bond, you're locked in for that duration, which isn't necessarily a bad thing because, again, locking yourself in to get 5% with, most would call risk free with treasuries, meaning they're not gonna default. You will have some fluctuations as rates go up and down, but the idea is to hold it to maturity anyway. Is not a bad idea. I think that time's coming soon. I think you're starting to see people dip back in to the bond market to take advantage of that. And reinvestment risk goes both ways. You want the opposite to be true with when you have debt. You want the lowest rate locked in for the longest period of time. Um,
Yeah,
so
I've got a good story from Howard Marks's recent memo. He talked about coming of age as far as an investment back in the 70s and 80s. And he said, I think it was an aunt he was having dinner, it's like a Thanksgiving meal, some type of big meal, a lot of people at the table. And she was more or less, not bragging, but letting everybody know what a great investment she just made. She bought a CD, incredibly safe, backed by the FDIC, et cetera. And she had locked in a 17% rate. And he said to her, well, what are the 5 year and the 7 year pay? She says 14%. It's like, well, we should have done that. Goes, why? I'm getting 7%, 17% this year. He goes, yeah, but 17% this year is great for 1 year. You could have locked in 14% for 5 years or 7 years. And she didn't understand the value of getting that lower rate for more years. And it's really just the effect of compounding. So if you can keep a higher rate for longer, that's going to end up being a lot better than kind of doing what a lot of bond traders are going to have to do over the next few years, which is just relative value, saying that yeah, treasuries are good today. If they go down, they'll just kind of go to high yield or they'll go to leverage loans or they'll do something else, just kind of where the relative value is. If you're an individual investor, you need to think longer term of how long can I get this 4, 5, 6% rate? If you can get it for 5 or 7 years, that can make a really nice impact on your ultimate underlying performance.
you bring up a good point too. You have this. The biggest thing about reinvestment risk is just that in 5 years, when those bonds mature that you're picking up right now at 5%, when that money matures, you need to go back in the market and buy a new bond. Well, that new bond might now be at 2.5 or 3%, or it could be higher if rates continue to go up. I doubt it, but it could be a lot lower. So if you're depending on that income stream as part of your fixed income for retirement, you're really the big challenge for you, the big hurdle is this reinvestment rate. When these bonds do mature, going back into the market at where current rates are, and you can take a big cut and pay, which is why you don't put everything obviously in one basket. You have other sources of income and pension streams, if you will. But I think that is reinvestment risk rate reinvestment rate risk in the
Valley
nutshell.
sells seashells down by the seashore, right? But I think that it's something that's often overlooked, and there's a few reasons why. One, for 15 years, it hasn't really been a thing with interest rates at zero. The future always looks brighter. The other part is that I don't think investors feel the same pain of missing out on gains the way they do when they hit losses. And reinvestment risk is really saying you're going to miss out on future gains by taking kind of the safe, easy 5% today. Go ahead and stretch a little bit, go out further on the duration, and you might be locked in at a higher rate for longer. The other thing you could do is consider a strategy like a barbell, where you're buying some of the short term, like money markets, and some of the kind of intermediate or longer duration, and that way you have both sides. And if rates go up, then great, you can invest some of that short term money into more long term as it keeps going, and you're protected for some of those losses. And if rates go down, you're still benefiting from the drop in rates on the long end, and you still have the opportunity to invest. And you didn't make as much on the short end, but you made a lot more on the long end because bonds will price according to prevailing interest rates. So it's a little different than CDs in the sense, or money markets in the sense that you can get that bond gain just by rates changing as they rise or fall. You might be able to capture that loss or gain versus the CD. It is what it is. There's not a whole lot to it.
Yeah, and what you're describing is bond laddering, and it's we haven't talked about it in probably over 15 years because of how low rates have been, but it's an actual proven. I mean, it's a strategy that works, and it works really well if you do it effectively and you know how to ladder out the bonds. And I think it's good for a good portion of the portfolio, depending on what your ages, target of income, etc. So.
Yeah, and then the other piece I would say is you mentioned municipal bonds. There's some really great opportunities, I think, in municipal bonds because so many of them looked out across the landscape a few years ago and said, we can borrow money for 2% or 3%. Let's issue as much debt as we can. And now, because of interest rates rising, some of that debt is priced at, 60, 70% of par value, but the coupon's 2%. So the city or municipality or the toll road, whoever it was that issued those, they're going to only pay 2%. Yet you might be able to pick up 5%, and on a tax equivalent yield, might be it's worth 7.25 to 8%. So they're not going to refinance those because who's going to cash in two when prevailing interest rates are 5 or 6? Even if rates go down, they're unlikely to go back down to zero. So some of those cities and municipalities that issued at two, they're not calling those bonds because they want to pay 2% forever. But you as an investor, because of rising rates, might have a chance to pick up a really nice thing, and you don't have to worry about getting called on them.
Right, right. And you have general obligation, you have revenue, which is backed by the revenue of the municipality. And in general, historically, they have lower default rates, per
Hmm.
their credit quality versus their taxable counterparts. And default rates right now, not that they can't pick up. I mean, that's one of the risks of buying an individual bond is that you don't get paid back at maturity because the company or municipality that you invested in goes bankrupt. Default rates are at all-time lows. So the biggest risk is if you have to get out of that bond before the maturity ends and rates are up and your bond prices are down and you take a loss. But if you can hold to maturity, you're going to clip your yield, get your coupon, and let it roll off. And I think that makes a lot of sense right now based on the low risk of default, especially the municipal side and where rates are at.
Yeah, so Moody's has a report you can find on their website. It's over 100 pages long, but I read it on a flight recently because the flight seemed to take a lot longer than I realized it was going to be. And they found about, we'll call it about once a year on average, there tended to be a default. And it's really kind of depends on the sector. So they had a lot of problems with healthcare related entities as well as housing, kind of public housing type of projects. Uh, Otherwise, they really don't default. And they found that within the prior year before default, it had to be rated BA2 or worse, or they just really don't default. It's incredibly rare. There were some exceptions, like Orange County defaulted even though they had a high credit
Yep.
rating, and it was done more as a strategic option. They had a lot of kind of Catholic municipalities that were concerned about some of their liability that defaulted in advance just to kind of negotiate with creditors. So outside of a couple strategic ones, the risk of default is incredibly low. And look, if you own a sewer or a municipality water system, they just raise the taxes because people are going to still need those two things. And for general obligations, it's not even a state, but Puerto Rico's been the only one that's really had a major problem. Often cited are Illinois and California for ones that are at risk. But by and large, states, municipalities, they hit their budgets, they pay their bills, and they tend to be pretty highly rated. So if you're looking for something to avoid reinvestment risk and you want some higher quality than maybe some corporations offer, munis can be a really great choice.
Yeah, and I'll end on this with the default stuff. It's like an upside down hockey stick. The closer you get to maturity, the lesser and lesser likelihood of that bond defaulting. And not only that, but even if the issue does default, as far as creditors go, you're almost at the top of the list. So you're getting, it's not defaulting, you're getting zero back. You might get 60, 70 cents on the dollar. So it's not like it's defaulting and you're getting nothing. You are recouping some of those funds back. So to your point, not that it can't happen, not that it can't go to zero, not that the defaults can't pick up across the board. It's just historically highly unlikely, and it's been a great place to generate some tax-free income.
Yeah, and look, there's a lot of detail and nuance to it, so make sure you work with an advisor or somebody very qualified before you go and just buy a bunch off the shelf. But that was great.